This is our Forex blog for March 26, 2013, and there's many ways to use our software. One of the best ways is either using our currency indexes here or our old currency meter, which lets you know which currencies are strong, which ones are weak, and you just simply want to buy the strongest pairs versus the weak. One enhancement I put in today actually is something that tells you how many pips, or in this case, this is based on the dollar index, yen index, pound index. These don't actually trade. It's a synthetic instrument I created just to help us gauge what the trend direction is, spot high probability trades such as double tops or trend line breaks, for instance. Actually seeing every euro pair in a chart format is, in my opinion, one of the most predictable ways of trading I've ever found in my life. And so the point of control, which is the yellow line, is the price most traders have positions in all the dollar pairs. In the euro, sometimes it might be off the chart. You can zoom in and out, zooms out. You can see the euro's point of control fell 31, for lack of a better term, pips from the previous day. And so it was in a very big downtrend. The pound fell only 6 pips, the CAD went up 31 pips, the New Zealand up 39 pips, the Australian, if you zoom out a little bit more, you can see that's up 27 pips. So these three went up significantly yesterday, and so if you see any signs of strength in them today, it makes sense to buy a currency that was strong yesterday, and today's a continuation. So some of the trades that I like are sideways rectangle patterns, and I've said that for the last 6 years that we've done daily Forex classes. The longer the better, but minimum time 30 minutes to 2 hours. Breakouts from above to below the hourly moving average, high probability, and obviously not all of them going to work. The first one worked, the second one failed, the third one worked. Breakouts over from below to above the point of control, very high probability. You can see that the point of control tends to act as support and resistance the majority of times it gets hit. And notice here in the pound, the point of control fell 6 pips from where it was the previous day, and price was underneath there, couldn't get above it. That's a pretty big sign. Yesterday, the market went down slightly in the pound index, and today it can't get above resistance area, a very high probability trade. Just like the CAD went up 31 pips and the New Zealand up 37 or 39 pips. This one went up 27 pips. These three went up, and so when you get a breakout, and yesterday was strong, it's much more likely to continue. So getting back on top, or on talking about the sideways rectangle pattern, you have another one right here. And so when you have a strong currency, these three, you want to trade them versus the weak ones. The euro fell considerably yesterday, as did the Swiss. Those were the two weakest. Let me see how much the yen rose or fell. We'll zoom out just to see. All right, so this one yesterday, the point of control fell 34 pips from where it was the previous day, but then later in the day the market exploded up. This is just where most traders have positions. As you can see, it went sideways at that price for a long time. That's why this is down here. If price is above it today, it's certainly more likely to go up. In this case, it's hovering mostly below the hourly moving average. Currencies that are between the point of control and hourly tend to chop around. It's not the best trade in the world. You really want a currency that's underneath the value area the previous day, the point of control, and below the hourly for sells. When they're above both, like this for the Australian, it goes up right here, New Zealand up. CAD is above both of them most of the day, up. Pound underneath both of them, it trends down. It's that simple. All right, so let's take a look at some trades that you can anticipate. The pound slightly fell yesterday. It's underneath its hourly. You might have sold it here when it couldn't get back above the hourly during that hour. This little sideways rectangle right here, sell. These are three relatively high probability sells along with this one. This is the previous day's low for the pound index. Looking at that last one at 9, you can see the CAD broke out above the previous day's high. Strong CAD, weak pound. Obviously, you want to sell the pound CAD. It's that simple. And I'm just going to try to focus on some of the highest probability trades that are pretty easy to spot beforehand. So let's bring up the pound CAD. Like I said, when one currency is likely to go down, the other one's likely to go up. When one currency has gone down yesterday slightly and the other currency had gone up a lot the previous day, you're definitely trading with the trend. Here's coming up to 9. You can see it's got a nice little 2-hour rectangle pattern here and an even smaller one inside the 2-hour for the last 40 minutes here, or hour. Very high probability trade, and of course you always draw your fibs off the last swing to get a feel for where the profit target is. Typically, I'll tend to exit most of my trade at the 1.618. If it stalls at the first fib area, 1.32, I'll exit half and then use a trailing stop or get out of the second half here. If it shoots through the first one, I tend to be out of the whole thing here. Notice our perfect oscillator, which I call perfect because it's more accurate than any oscillator I've ever found. Normally I've never traded with oscillators. These minus 80 levels and plus 80 levels tend to reverse price. And if you look on this, you'll see it reversed right here, reversed right here. The market kind of just went down 5 or 6 pips, but for the most part reversed. This one right here that got hit, it went up 10-15 pips. The second one right here, about 20 pips. And I don't know, this is more of an advanced topic. I hate going over basic stuff for new traders all the time. Sometimes you get a double bottom, or in this case slightly lower low, but you have a divergence in the oscillator. Those are very, very high probability. Also, one of the higher probability trades is when you have a clear trend. In this case it's down, and you get a move to the upper oscillator extreme area, the plus 80 level. What a high probability place to get in. You just flat out sell that level, and you can see it fell 20 pips in that hour. Just very high probability. And that's how you can put all these tools together. And you can also use our currency meter underneath the indexes. This shows statistically how strong or weak each pair is. Usually when you get minus 80 levels or very close to it like that, that's the trend that's very likely to continue off the next pullback. And you can see it pulled back up to the hourly, couldn't get above it, didn't have much strength in comparison to the weakness before. At 8:30, pretty decent place to look for a sell in the euro. So what was strong at 8:30? Well, of all these 4 pairs, the dollar's the strongest at 8:30. You could certainly consider from these, looking only at these 4 pairs at 8:30, looking for euro dollar sells. So let's take a look at this actual chart. Here's 8:30. You can see this one's kind of chopping around the hourly right here. This is probably the worst example I might have shown in the last few months. Typically when you go short, you want to put your stop over the high. This one only went down about 8 or 9 pips. Usually that's enough for me to move my stop in half, and we would have lost 5-6 pips on that trade. And as most people know that watch our blog for frequent amount of time, I tend to trade more with a range chart. This is an example of that. At 8:30, the actual trade would have been to sell it right here at 68 when it went 1 pip underneath the low. I put my stop above the bar's high right here, and usually if it breaks down and doesn't continue underneath the hourly, I put my stop underneath here, and on a range chart you might have even made a few pips on that trade. Let's go back to the list here to showcase some of the high probability trades. Breakouts, like I said, very high probability, especially when the previous day the point of control went up 31 pips. That's considerable for the index. The first pullback after a big breakout tends to be predictive, and also double bottoms right here. At 10:30 and 11:30, you're looking to buy the pullback in that pair versus one of the weakest ones. At 10:30, the pound looked weak. At 10:30, the yen, and it really wasn't able to get above and stay above its hourly all day. You can see clearly a nice trend line forming there. You could certainly trade the CAD versus the yen. So let's take a look at pound CAD sells and CAD yen buys at 10:30 and 11:30. The higher probability one is the CAD yen. You can see 1030 and 1130. The 1130 is a better trade because our perfect oscillator is actually hitting the lower Bollinger Band of this particular oscillator right here. You might have actually got into this pretty much within a pip or two of the low of that pullback, and it went up over 40 pips. At the 1030 trade, if you bought the breakout right here, you might have actually got stopped out of that little wick here. So you might have lost 10 pips the first trade. If you look to buy the second trade here at the breakout, and a lot of times when I see it near the oscillator, I will, if it's a decent pullback and I have other chart-based reasons, I will just flat out get in at that bar with just a very tight 6-7 pip stop. You can also go down to a tick chart, maybe 10, 20, 30 ticks per bar, and kind of get into it on a much faster time period. But if you look at our perfect oscillator, these extremes, another reason why I call it the perfect oscillator is how often the D's price either reverses or stalls at these levels. Obviously, if you're trading with a trend, you're going to be better off. But notice, end of the move down. This one here did go up about 12 pips, but then it continued on down. You had a lower low with kind of a double bottom in the oscillator. That was the end of the move. This one here failed, so there's one real loss on that. You would not have had enough movement to trigger any kind of winning move. You would have lost here. This one nailed the low perfectly. This one nailed the high perfectly. And ideally, if you see a trend that's up and you get a pullback where the lower oscillator gets hit, or even the lower bands, pretty high probability place to get in. You can see again right here. You know, I like to see a 15 to 25 pip pullback typically. This is about a 20, 24 pip pullback right near the lower band. Very high probability. So let's take a look at the pound CAD. Remember, the CAD very likely to be going up at 10:30 and 11:30, which means the pound CAD is going to go down. And so you can see the first instance, the pullback hit the upper band. You know, if you were watching this on a faster range bar or tick chart, more than likely you could have made a few pips on this. The second trade fell. Let's just say you waited for the breakout of the low of that little range. You would have been in somewhere around 22, and it pulled back to this level right here. Also note this level right here, right at the upper extreme in our perfect oscillator. Very, very high probability. I think I might have just showed that one. Let's go over one last anticipatory trade. Let's look at the New Zealand, because this one went up the most yesterday. And then obviously later in the day, last night, it must have kind of just consolidated up there near the high. So when it breaks out over the point of control, very, very high probability trade. Also, anytime you have a very strong trend that, you know, I like to call this event-based trading. Anytime an event happens, it tells you it's likely to go up. Yesterday was a big up day. Today it found support at the hourly pretty much all day. Breaks out. Anytime you have a nice 2-3 hour rectangle pattern, that's a very high probability breakout. So a little bit, even though I don't like to trade during this time of the day, pretty high probability trade. Let's take a look at the 9 o'clock trade there. We already saw what the CAD did. At 9 o'clock, you can see the Euro's weak, the Swiss is weak, the yen looks weak. So let's take a look at the New Zealand yen buy at 9 o'clock. You can see 9 o'clock right here. It's been hovering above the hourly for the last 2 hours. And it goes up about 14 pips, pulls back. Notice where it hits the lower containment band. I'm sorry, the lower Bollinger Band on my perfect oscillator. Pretty high probability place to get in, especially when we've just made new highs for the first time pretty much all day. The only other trades I would consider is this next one right here, and possibly this pullback, mainly because it did go below the perfect oscillator. A lot of times, or the lower band on the perfect oscillator, a lot of times when it pops back above there, very high probability trade, like there and here. But this is kind of getting into the more dead time of the day. You can see that one went up 20 pips. Let's look at, I'll do one more example. Double tops and trendline breaks, also very high probability. So this is anticipating future price direction. We all know the euro fell yesterday, wasn't able to get above its high. 730, very high probability down, and of course it did. And this is a big, anytime the index moves 10 pips, for lack of a better term, because this doesn't exist other than, you know, it's a synthetic instrument I created. You can see that this one's weak, which one's very strong at 730. Well, it looks like the Australian's about to break out. It's right near the previous day's high. It's above its hourly, above the point of control. I would look for a Euro Australian sell. It would be one of the higher probability trades. This one is probably going to go 30 plus pips. 7 o'clock, we're looking to sell this. Notice this found resistance at the hourly moving average 3 times. It also has a nice little wedge pattern right here. And, you know, at 7 o'clock, you're looking to sell this. Maybe about 20 minutes goes by, it breaks the trend line right here. You can see it fell from 85 all the way down to 55. It's a nice 30 pip move straight down. And that's how we pretty much use this tool. And you can use the perfect oscillator to kind of get a feel for when the market's gone too far, like right here. It went back above the perfect oscillator. You might want to be looking to get out of your trade down there. Of course, that's the end of the move. We have a clear downtrend in this. So like I said before, anytime the perfect oscillator goes up to the extreme high, plus 80, pretty decent place to sell. Fell about 20 pips. Again, right here, nailed that high perfectly. And that's, again, why I call it the perfect oscillator, because it doesn't use periods back. It's all based on statistics for that time of the day, and it compares volatility for different times of the day to what's going on today. And it will let you know when the market's pretty much done, as you can see right here, done. Below, it pretty much was done. Below here, done. You got a big 20-30 pip move up. And some people are telling me that they're just trading pretty much primarily off the perfect oscillator at these extremes. So I mean, you certainly can do that, although I like to use all of our best tools when I trade.